Hello, chart watchers and DecisionPoint faithful. Welcome to this Friday, June 7th, 2019 DecisionPoint show with your hosts, Carl and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. I hope you'll be back. And for our regulars, welcome back. All right, let's go ahead and just jump right on in here. Dad, you're doing good up the hill there, 5 minutes away?
Yes. Very, very well, yes.
All right. Well, good to have you along as always. So let's go ahead and look at the agenda. So we're going to do our regular look at the the broad market indexes. I like to look at the price relative of those major indexes with the S&P. Of course, it's end of the week, so we do our weekly review of the scoreboard indexes. And then today we'll go over the DP indicators, but I have a little bonus chart for you on the new highs because we're making some, climactic moves there as far as the new highs. Carl's going to be going over the big four: dollar, gold, oil, and bonds on the daily and weeklies. And then for our bonus today, we're going to look at a yield array. And I have to say, Carl showed me those charts. They're quite pretty. And then we're going to look at some of the VIX divergences. So stick around for all of that. Let's go ahead, though, and start off looking at our DP scoreboards. We didn't have any changes this week, but we did come up with one just today. The Dow did end up with a PMO buy signal. That means that the PMO crossed over its signal line. So we will be looking at that. The rest of them, while they didn't get those PMO buy signals, they are very close, particularly the S&P 500. All right, this is our DecisionPoint sector scoreboard. On this scoreboard, we look only at the intermediate term trend model and long-term trend model signals. A intermediate term trend model, that's your 20, 50-day EMA crossovers. If the crossover occurs above the 200-day EMA, it becomes neutral. If the crossover is below the 200-day EMA of that 20 and 50, then it's a sell. Anytime it's positive crossover, it's always a buy. Long-term trend model just tracks our 50, 200-day EMA crossovers. So currently we're looking at energy and materials having that long-term trend model buy signals, sell signals in place. Carl and I talked about it a little bit before the program, the intermediate term trend model neutral signals. A lot of these that we're seeing that flipped recently for these sectors, they're actually, of course, with the rally we've seen here at the end of the week, they're starting to pull away. They're above their moving averages. And so it's just a matter of time, really, before we get those to switch to buy signals. All right, let's go look at some of those charts we have for you. I'm going to start off right now with the Dow Industrials, looking at the price relative of the Dow, NASDAQ 100, OEX 400 and 600. And what I'm noticing is that the Dow Industrials, and it is apparent, right? That was the first PMO signal to change. Right now is starting to perform slightly better than the S&P 500. That's probably why we're seeing that move in materials, and even energy starting to pick up a little bit more. But anyway, the Dow Industrials are now starting to slightly outperform the S&P 500. At this point, tech is trying to come out of that declining trend as far as its price relative. OEX is continuing to move lower, but if you look in the thumbnail, we've got both the NASDAQ 100 and the OEX, moving slightly. They are starting to perform a little bit better than previously against the S&P 500, but overall we're in these declining trends for the S&P 400 and 600, and look in the thumbnail how we got those big declines as far as the price relative. We're not seeing the participation yet that we need to from the mid and small caps.
Well, just keep in mind, though, that all that shows is the 400 and 600 stocks are not moving up as fast. Mm-hmm. It doesn't mean stocks are going down. And I think that's one of the things that confuses people on.
Oh, good. Yes, make that very clear. Okay, broad market indexes. All right. The one thing I pointed out last week, and that I'll continue to point out this week, is, we made higher highs back at the end of April and May on the S&P 500 and on the equal weight RSP for the S&P 500. But note the S&P 400, 600, and those two have not managed to get up and challenge those all-time highs that we saw. Again, mid caps and small caps clearly on a rise. They're also enjoying a rally, but it's just not been enough the last time. NASDAQ starting to come up, but you can see that it had made new all-time highs back in April and May. So waiting to see if this declining trend on the 400 and 600 is broken. Global markets, how are we looking here? We look at all the various ETFs. Note here the rising trend. We don't usually mark rising tops, but it's really going to give you an idea that it is rising trend. We got all-time highs, new all-time highs, new all-time highs, but we're not seeing that as far as the Germany ETF, even the Canadian ETF. None of these really are seeing much of a breakout. India is starting to show some potential, but that $26 range, you can see that's the resistance area, and it did fail at that resistance. All right, Dow Industrials. Like I said, there's your PMO buy signal. It just came in. I like the way the OBV has broken that declining trend. But I am a little bit, I think the volume pattern here is just a little bit suspect. Certainly a nice positive volume coming in. But as we're really getting these sharp moves to the upside, we're just not seeing that volume, spike like I would have expected it to. And that always makes me feel a little suspect about what's going on, that we have declining volume right here, but we've got this very almost straight up rally going on.
And the volume's not making the 250-day or day average of volume. It's been consistently below that, so that's not good.
Right, and I actually did put that on my S&P 500 chart, so we'll look at that for sure.
Great.
Intermediate term PMO sell signal is in place. We did see the PMO turn back up here. But, with a week of being up almost 4.75%, I would expect nothing less, honestly, from the PMO. So we're getting that tick upward. Whether that'll turn into something more, we've seen these kinds of things before, right before some of these big declines. So I'm just, I'm looking at it as being a little suspect at this point. Let's look at the NASDAQ 100. You can see a nice breakout like we're seeing on all of them today, almost a 2% move to the upside. PMO is hooking nicely back up, but we don't have that buy signal recorded just yet. This is a 50-day EMA of volume. And again, last 3 days, strong rally, and yet the volume is still under the 50-day EMA for volume. And that I would just expect more than that out of these very strong rally moves. All right, there you go. Another tick toward the upside for the NASDAQ 100. It is still on its weekly buy signal, but might get a bottom here if we can continue, if this rally can continue on. At this point, though, again, you have a 4% move to the upside in a week. You're going to see those PMOs on the weekly charts slow down or turn back up. Daily chart for the OEX, same thing, hooking upward, not having the buy signal yet, getting ready to challenge the highs that we saw back in mid-May. Weekly as well, nothing too new here. Again, you're seeing the hook, those ticks to the upside, and we got that on the OEX as well. But let's look at the S&P, and then we'll look at those indicators based on it. So I have been watching what looked like a head and shoulders top. Head and shoulders patterns aren't patterns until they execute. It did execute when we got this drop below the neckline. However, we managed to hold on to support here at that March low, and it has rebounded. For me, I will hold open a head and shoulders pattern until it breaks the declining trend from the head to the top of the shoulder. We broke that yesterday and even the day before. So I am considering the pattern nullified at this point. I looked at one chart. It's not a declining, I think it's a declining trend channel. I didn't get a chance to mark that up. But here you go again. This one is, okay, this is still the 50-day moving average on the volume. And the last 3 days on these very sharp upward rally days, we're seeing a decline in the volume. It's positive, but it's below average and it's declining. So that should leave you a little concerned. Of course, we are seeing that breakout on the OBV from its declining trend, but that is something to pay close attention to. All right, on the weekly chart, we did manage to pop just above that previous top back at the beginning of 2018 when we came out of that almost parabolic move to the upside going into the end of 2017. We have a PMO that has ticked back up. And again, you've got almost a 4.5% move on to the upside within the week. So again, not surprising to see that PMO beginning to tick upward and possibly move to the upside above its signal line. All right, let's look at these indicators. The ultra short-term indicators have been quite interesting. I was wondering what it would look like today, because before the show we didn't actually have these final numbers, but look at the new highs. We're not getting quite the climactic readings I would have expected on breadth as far as the advances minus declines and the advancing minus declining volume. We're not seeing that same kind of climactic move. And we've got a VIX that hasn't even reached the upper Bollinger Band. So, there is the possibility that we're going to continue on this path to the upside. But boy, when I see these stretched out readings, it gives me concern. And here is why. I'm going to show you that new highs chart. And I did put that chart in the DP alert right here. No, I stuck it in the other one. So when you look at the new highs chart on I believe we made it into a 5-year chart. There we go. Look at these readings. These are really unusual that we're getting really high spikes here on this rally, which of course you look at it, it's almost straight up. But like I said, we're not seeing the same information out of the advances minus declines. What I would note is that with readings this high, you can see where these are spikes. That's a pretty high spike. There aren't a whole lot of times where we've seen readings above that. And unfortunately, a lot of times they do arrive at exhaustions. Selling or buying exhaustions. So that would be something to consider. But I saw the same reading back here. That was from Wednesday. And I was already looking at that like, wow, we could be looking at a buying exhaustion. Yet we've continued higher. We've rallied higher. But now it's just really getting stretched out here. And as you can see, typically when we get this was a very strong bull market. It started to move sideways. We didn't necessarily get, the big decline, but I think it's something to consider for sure. All right, and then I'm going to look at the short-term and intermediate term, pass it right. We'll look at your charts next. So let's go back to the live chart list and away we go. So the short-term indicators, I suspect, and again, I hadn't seen the final reading. Yes, overbought territory. This reminds me a lot of what we saw back here. That's why I had boxed these out when I talked about it on Wednesday. And we're getting that follow through in the same way. So I would just say at this point, everything's looking pretty good. It's nice to be part of a big rally like this, but we're starting to see these short-term indicators get very overbought. And typically that is followed by a decline. So just keep an eye out. And finally, my last chart is our intermediate term indicators. We finally got positive crossovers, and that's all good. Turned up in oversold territory, which is also good. But we're not seeing readings above zero just yet. So I'm not going to really get really bullish and excited in the intermediate term until I see at least positive readings going on here, and we're just not getting those just yet. All right, let's move on to the big four and take it away, Dad.
Okay, you can see where the dollar this week has broken down from a smaller rising wedge and now is about to challenge the bottom of the larger rising wedge. Let's try the weekly.
Okay.
And now we see why the reversal, we have very long-term resistance. As I said, that resistance lines goes back to 2008. And even though we're going to test, maybe even get down through the bottom of that bigger rising wedge, the PMO is still strong. It's positive and still flat. It could become more distorted to the downside next week, but right now, all is not lost.
Mm-hmm.
Gold did very well this week, challenging that short-term resistance drawn from the February top. You see we had a triple bottom, and it's come off of that very well. Very strong looking PMO, and I was distracted. I was looking at the premium discount section, and we haven't posted for today. But that section is, we have to see sentiment switch to green, not in extremes. People that are in early on a move, the sentiment is low. Those people are right. It's the problem with the people who come in late. They're the ones that end up being wrong.
Mm-hmm.
So right now, we don't have enough upside action to get people excited about gold.
Mm-hmm.
You see now the long-term resistance line just ahead, but the PMO, the weekly PMO is turned up, and I'm liking this move and looking forward to higher prices.
Yes.
Oil finally came back a little bit this week. Actually, it closed up slightly. No, I'm sorry, that's today's move.
Mm-hmm.
No, it didn't close up for the week yet. But it's just an oversold bounce at this point, and PMO hasn't turned up. Let's look at the weekly.
Mm-hmm.
Weekly PMOs crossed down through the signal line. And I've got the crude oil chart up there, WTIC, just to show that there is support around 42. So that's possibly a downside target at this point, assuming that the prices will continue to fall.
Mm-hmm.
Last week, I pointed out the parabolic rise on the TLT. And the issue here is that it's a short-term parabolic. So long-term parabolic can be devastating when they finally break. This one, we can have a good pullback, but maybe say not below the rising trend line. Not that one, but yeah.
Yes.
rising trend line. Here you go. And so right now the PMO looks strong, and that parabolic is broken at this point, but I may have to adjust that if it continues to make new highs. Let's look at the weekly. Okay, you can see long-term resistance just not too far ahead. A very strong weekly PMO. You just have to see. But again, I think bonds are not going to run too much more. I think they're pretty much run out of what they're capable of going up on the upside.
All righty. Bonus time.
Right. I modified a chart done by one of our other contemporaries up there. Greg Schnell, I think, is responsible for this particular design. And I wanted to point out, I did the 1 month and the 3 month bills and the dotted lines. So you can see where the shortest term interest rate is higher than anything else except for the 30-year bond.
Wow. Next one.
Right.
This is the pretty one.
Yeah, same chart over 35 years. It's what I wanted to demonstrate here was the compression that we have currently, and the rates are starting to correct downward. It's basically, there's an inversion on everything pretty much. And if you go back to 2006, 7, 8, we've got a similar situation. So the correction for this inversion is probably going to go all the way down to the lows we saw earlier this decade. I should comment that I have used a semi-log scale on the S&P 500 panel on the bottom. I don't like semi-log, but sometimes in this case, you need to use it to get any sense of what prices were doing in the earlier days. Otherwise, it would be just indistinguishable. But if you look at that, the last time in 2008, we had a market. We had a bear market. Similarly, in 2000, we also had a bear market. I don't know if you can rationalize that kind of reaction earlier on. So, but here are like 3 data points that we can use for comparison, which is not a lot of data points, but best we have at the point here.
Mm-hmm. Excellent. A lot of people have been talking about, the inverted yield curve and.
Right. I wanted to get this up because it gives people a picture. I mean, it makes sense. Otherwise, it's just fuzzy talk out there.
Mm-hmm. And then what happened here again with the 30-year bonds?
Yeah, they didn't issue any during that period. So that's why the data looks squirrely.
Right. All right. Let's see. We still have about 5 minutes. A little less.
Yeah, I've got a couple of others. I had an epiphany this week. Don't know if it'll sound as important as it did at the time, but here's what we normally see with volatility index charts. That's a standard display. Mm-hmm. I've had no luck with making any sense out of it over the years. Doesn't mean it's not useful. Some people do find it useful, but to me it doesn't. So I changed along the line someplace I don't know when. I'm not even sure if it was me that thought it up or if I just reinvented the wheel or I got the idea somewhere else. I'll go to the next chart.
Okay.
Okay, we've got now the bottom of there, we have the way I like to display the VIX, the reverse scale and inverted. And one of the things that came to me this week was, holy mackerel, this is a direct line to sentiment, the VIX, because the VIX is calculated off of premiums for a certain set of options. And when the premium goes up, people are getting worried. When it goes down, people are complacent. So we're getting a look at that here. And I've never used divergences on the VIX chart. I never thought about it. But here, the most recent we have in May and right at the beginning of June, we've got a higher low versus a lower low in price. So that's a positive divergence if there ever was one. And again, I say it's more interesting because it really reflects sentiment. It means people are really not too uncomfortable with the fact that prices are going lower. So it was a Monday, I think Tuesday is when it went up. Tuesday, it had the breakout. And but if you look at the VIX scale again, it's the chart it's right between the bands right now, and it looks like a top. So we could be looking at some more downside next week. But again, let's get back to those divergences you see in April. We had a negative divergence on the all-time high, meaning people were getting nervous at that all-time high and ready to go for the door. And then moving back to March, you can see a positive divergence. You've got equal lows against a higher high. And then going back to October, you've got prices going lower, and we have a repeat of what we just saw. We have a higher VIX high, and I say high based on the presentation here, not by the number.
Mm-hmm. That is interesting. I have to say, I haven't seen this chart that you annotated. We didn't really talk about it before the show. I present during the sentiment report on Market Watchers on Mondays, and I always include the VIX, but this is not something I really looked at before, and I think this makes a lot of sense. It really does, because we do use the VIX all the time as far as nervousness goes. And I remember when I had to start explaining why I inverted my scale because, well, you always did that. So now I can explain why. But all right, well, goodness, we've got to close it out here soon. So I appreciate everybody coming. I thank you. Please take that survey. And we do air on Fridays at 4:30 p.m. Eastern. Have a great weekend. Happy trading.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.